Just talking about the won market, which is among one of your picks for Asian currencies. In fact, you're saying go long on the won versus the yen.
Yeah, it's actually become a pretty popular trade, but we've been involved probably since March of last year. We just saw the distortion in the capital account in Korea as a result of a lot of the shipbuilders over-hedging with fancy option structures they didn't fully understand, created an opportunity for a mean reversion trade, a normalization trade, and we think that has a way to go. We think it has a way to go against the dollar, but probably more to go against the yen.
Yeah, and Trish was saying that analysts were predicting maybe 7 to 8% appreciation versus the dollar this year. Does that sound about right to you?
It could be. It's always hard to predict the exact amounts of things, right? The markets end up being a lot less precise than you thought ex ante. But yeah, I think there's further scope for appreciation, despite the fact that the authorities would like to slow that down. But on the other hand, they're going to keep rates low probably for some time in Korea, which won't encourage people to pile in at too fast a rate, just because they have a credit overhang. Korea really has a credit overhang that they have to work through, and it's going to take them some time.
Yeah, let me just ask you, with this cross, the won versus the yen, how much do you think you can make in this trade?
My guess is probably 15–20%.
Well,
it might take some time, and it's also quite volatile because the correlation of the yen to other currencies is not very stable. So there may be days when you lose money on both your long leg and your short leg, and there may be days when you make money on both legs. But it makes for a more volatile ride, but it's a good fundamental trade, and there's a lot of normalization left in it. You
know what I found really interesting in the notes for you, Mark, is that you said that the dollar carry trade is a myth. People are actually not going in to bring U.S. dollars and
no, that's not it. What it is, I think there's a fundamental misunderstanding of what a carry trade is. A carry trade is something that you put on when you're trying to make money on the interest rate differential between what you buy and what you sell. And if you think about the interest rate differential between the dollar and the euro, which is 1%, or the dollar and Aussie, which is a little bit over 3%, and you compare that to the daily volatility of these currencies, it just doesn't make a lot of sense to hold on to it. For the Aussie dollar, if you hold onto it for a year, you get a 3% pickup.
Right. That's it?
That's it. So it moves over 1% a day if you look at implied volatilities. It just doesn't make a lot of sense. But people have come to say it. A real carry trade these days is in the credit space where you're not taking currency risk, because currencies tend to be so volatile that the interest rate differential has to be really, really high for you to get in your expected return to get the bulk of it from the interest rate differential. So it's just a misunderstanding of a lot of people that aren't involved in these markets.
Oh, so the carry trade exists in credit rather than currency.
Yes.
Okay. Well, now quickly let's go through gold, because another interesting contrarian call from you, because you don't think gold is going to get higher from here. People are going to sell gold.
Yeah, well, you never really know what's going to happen with gold, because it's more of sometimes a religion than it is an asset for a lot of people. But and you have to be careful and be disciplined about your stop losses. But I think the thesis is fundamentally flawed. It could go much higher from here, but the thesis at some point will come to an end, and that is people buy it because they're afraid of inflation, they're afraid of systemic risk, they're fearful of fiat currencies, and a lot of large hedge funds have very, very large positions, and the inflation story is not turning out to be as robust as people thought. The systemic risk, by and large, is declining, even though we'll see what happens in Europe, right? And the fiat currency fear will decline over time. People are going to look back and say, you know what? Central banks weren't as incompetent as we thought they were. And when that happens, these guys that have big positions, there's some hedge funds with massive positions in gold, are going to have to get out, right? So I don't think the story is as compelling as people make it out to be. The inflation worry, the printing money story is overblown, and when that disappears, people will have to get out of their gold.
Mark, nice talking to you this morning. Thanks for coming by. Mark Dow of Pharo Management.